Welcome to the Candlestick Forum Shooting Star Signal Training Program. My name is Steve Bigelow. I've been in the investment business for over 35 years as a stockbroker, and then later came across candlestick signals about 25 years ago. Since that time, I've written 3 books on candlestick analysis. What I have discovered over that time frame was that out of the 50 or 60 candlestick signals available in the candlestick universe, there's only 12 signals that you really need to learn. The 12 major signals are considered major signals because they occur often enough that with these 12 major signals, if you recognize where they occur and you understand why they occur, you pretty well have a grasp of understanding how prices move in the markets, understanding well enough that it puts you in the category of a seasoned trader. This training will go into detail to explain why a candlestick shooting star works effectively and where it works most effectively. The Japanese rice traders gave it a shooting star name because it looks like a shooting star coming out of the sky. There's only one basic rule to candlestick analysis, and that's the number 2. In the case of a shooting star, the 2 is that the tail should be 2 times greater than the body. This signal becomes very effective, especially when it's in the overbought conditions. And our overbought conditions are when stochastics are in the overbought area, above 80. The numbers that we use on our stochastics are 12, 3, 3. A shooting star signal is found at the top of a trend. After an extended uptrend, there comes a point where the bulls and the bears find equilibrium. It's usually found in the case where the bulls have taken the price up, and by the end of the day or whatever time frame, the bears have knocked it back down so that it looks like a shooting star coming out of the sky. Now, time frame is whatever time frame you're working. The signals work just as effectively on the 1-minute, 5-minute, 10-minute chart combination as they do on a daily, weekly, or monthly chart combination. And as with all candlestick analysis, if one signal starts showing the bears are taking control, multiple signals are that much more evident the bears are starting to take control. In this case, we can see a small shooting star doji followed by a lower open. That is the confirmation that you require after seeing a candlestick sell signal. Is the sell signal, and then the next day showing the bears are continuing the downtrend from this point. Shooting star signal, next day shows weaker trading, the bears are taking control. The reason the shooting star signal is so compelling is that the Japanese rice traders over the last 400 years have observed that every time you see a shooting star, especially in an overbought condition, and you see it trade lower the next day, it starts a downtrend. Does it go straight down? Not necessarily, but a shooting star signal, as well as any other candlestick signal, is usually the indication that you've reached a level where the bears are now going to start pushing back. A candlestick sell signal, like the shooting star, needs bearish confirmation the next day, which is a lower open and starting to trade down. The body of a shooting star can either be a dark body or a white body. It doesn't matter. The compelling indicator is the tail, at least 2 times greater than the body to the upside. Essentially, again, this tells us the bulls were in control, and then the bears knocked it back down by the end of the trading time frame. And it becomes very simple observation that the more tails you start seeing to the upside, or the more shadows to the upside, with the bodies trading back to the lower end of the trading range, that each time the bulls take it up, the bears are knocking it back down. Get ready to look for bearish confirmation. Now, on these charts, you can see that we're relatively simple, not a lot of indicators. Our indicators are the 200-day moving average, the 50-day moving average, and the 20-day moving average, the gray line. These are simple moving averages, and the reason we have them on our charts is because every major money manager around the world uses those moving averages to make their decisions as far as their portfolio. The advantage that we have as candlestick investors is we can see exactly what's going on in investor sentiment at those specific levels. Also, the most important moving average on our chart is this black line. This is our 8 exponential moving average, known as the T-line. Very simple rule. If you see a candlestick buy signal and then a close above the T-line, you will stay in an uptrend as long as you don't see a candlestick sell signal and a close below the T-line, such as right here and right here. A doji shooting star followed by a weaker open and a close below the T-line. You're now in a downtrend until you see a candlestick buy signal and a close above the T-line. Again, these tails to the upside are giving evidence that every time the bulls take it up, the bears knock it back down. When we go through these charts, you're going to see a lot of reiteration or repetition, because learning candlestick analysis is nothing more than merely recognize visually what's going on in a chart. Also, if we understand how these signals are formed, what investor sentiment was created or used to create these signals, we now have a very full understanding of what makes reversals occur in a price trend. Here's a case where the shooting star is followed by a lower open the next day and a close below the T-line, starting our downtrend. Many candlestick reversals include more than one sell signal. In this case, we have a bearish harami, which we will have training of that in this training session. We have a doji. We have a shooting star signal, followed by a gap down that starts the downtrend. One of the strongest pieces of evidence to tell you which direction they plan to move is a candlestick sell signal followed by a gap down. That basically indicates that these reversal signals are now confirmed not only with downward pressure, but extreme downward pressure when they gap it down and show they definitely want to be out of this position in a hurry. A shooting star signal has a very obvious telltale sign, and that is the upper tail or the upper shadow extends up above any of the trading range, and the bears start coming in and reversing it. This is like a neon sign up here that you've had a strong bullish move to the upside, and then all of a sudden they've now turned it around. Notice what they did on this one. They opened it lower, popped it back up one more day above the T-line, but didn't show any signs of strength and closed it back down below the T-line and continued a long downtrend. What this basically tells us is not every signal is going to occur and immediately have a downtrend. It usually gives you the impression or the inclination that this is where the selling has started. They might pop it up one more time, but this was the indication that the sellers were now taking control. Once again, if one candlestick sell signal shows reversal, 2 candlestick sell signals is that much more confirming that the bears are taking control. In between time, spinning top, doji, indecisive trading, but the decision was finally put to bed when they opened it lower and closed below the T-line. That basically started the major downtrend. Look at the message given to us at the top of this previous trend. Little hanging man doji, 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 shooting star, hanging man, shooting star, bearish confirmation. Two very clear messages up here that every time they tried to take it up, the bears knocked it back down. Two shooting star formations followed by a close below the T-line starts your downtrend. A shooting star followed by a bearish engulfing signal. What we should have learned in the bearish engulfing signal training is that if you see a signal or a series of signals followed by a bearish engulfing signal, that bearish engulfing signal kind of puts the final touch on the trend, that's where the bears are definitely taking over. Now notice that this one came down, this trend came down, popped back up, but the overall trend started with this candlestick sell signal, basically a shooting star, bearish engulfing, left-right combo, which is a very strong indication that the downtrend would be in progress. As with all candlestick sell signals, the bigger the signal, the more compelling it is that there's been a change of investor sentiment. Note the magnitude of this signal compared to the rest of the trading days. This was an extensively large signal. Also a left-right combination with a huge move to the upside that not only came back down but reversed direction once after it opened and closed below the 50-day moving average as well as the T-line. The more elements you can put into the analysis of sell indications, the higher the probability you're going to be in a downtrend. The more indications, a gap up, stretched way up, came back down, the next day they open it lower and take it down. Where's the first likely target? Down here to the T-line. This is what kind of helps eliminate the fear of getting out of a position too early. A candlestick sell signal followed with bearish confirmation puts you in a situation where the probabilities are extremely strong. The bears are starting to take control. One of the biggest fears that most people have is selling a position and having it keep right on going without them. Remember, the Japanese race traders have spent centuries observing what happens after specific candlestick reversal signals. The worst case scenario is once you become confident with a candlestick sell signal, you take your profits. If it comes back to the logical support level, the T-line, and does a buy, you can always buy it back in. The nice thing about candlestick signals is they tell you when to get out of a position and when to get back in. In this case, there was no bullish confirmation yet at the T-line. If you happen to have gone short, this kept you short all the way down until it closed up above the T-line. The bigger the signal, the more compelling the reversal is that you're in a downtrend. Even the next day, when they didn't open it below or lower, when they opened it, they sold it back off. Still might not have caused a reason to go short here, but when they gapped it down from this area after the big sell signal, that was more evidence that the bears were now taking control. You wanted to be out of the position and or shorting this position. Candlestick reversal tops doesn't necessarily turn on one signal. Notice that we had a bearish engulfing signal, gap down, tried to support on the T-line, bounced back up, but this time we had a shooting star confirmed. The whole combination of selling going on up here gives us a good impression that the bears are starting to take control, and the probabilities are pretty strong that if you start seeing confirming selling after the signals, that they're going to take it down. A signal followed by a gap down not only tells you that they have changed their investment psychology, but now that new trend with a gap down says there's going to be a strong force in that direction. As with any candlestick reversal signal, notice we have a doji shooting star. The next day they gap it down, especially when they gap it down below the T line. That gives you a much higher probability that you're going to be in a very strong downtrend. That gap is a force that's telling you that the bears want to be out of this position very quickly. The candlestick signals are important. Shooting star, doji, a doji shooting star. But the real compelling confirmation is coming out of that position. When they gap it down, that force will push it down much quicker than if it just starts to sell off. Your trajectory on the sell-off may be like this, whereas a gap down, your trajectory may be much stronger. The simple rule with candlestick analysis: if you see them gap it up in an overbought condition, start watching for a sell signal. Here we had a case they gapped up, did a doji, the next day they did a shooting star, gapped it down. That was kind of the start of this downward trajectory. Shooting star, gap down. Remember, a signal followed by a gap is your best friend. Where most other people will say, I don't want to short a gap that's already down 3, 5, 7, 10, 15, 20, 30%. You do if it follows a candlestick signal, because that tells you there's a force that's going to continue that trend much further. And as mentioned earlier, the advantage we have with candlestick signals is we can see exactly what's going on in investor sentiment, especially at major resistance levels. If we're in an uptrend and we're heading for a resistance level, we've got the advantage to see, once it got up there, a shooting star in the overbought condition told us that they were not going through this 200-day moving average. It was time to take profits. They were probably coming back to test another lower level. And what can be more exacting is observe the obvious. The obvious was, after the strong uptrend, they just touched the 200-day moving average and sold off. Notice that the ultimate shooting star is a gravestone doji. What do we want to see the next day to tell us that the selling has started to take control? A lower open. The ultimate shooting star, the gravestone doji, pretty much tells us immediately that they're not going through the 200 right now. They're pulling back. Take your profits as soon as you see the shooting star gravestone doji confirmed. That's getting out immediately the next day on weakness. The only way to have stayed in this trade would be to see it opening stronger and then continuing to move higher. The visual aspects of candlestick analysis is a great benefit because we can see immediately what's happening at levels that everybody else is watching. Where does everybody expect there to be a resistance? Right here at the 200-day moving average. If we can see they've taken it up and immediately started bringing it back down, we know that they have failed to go through. And if we can project that this is the type of signal that might be occurring up here, you can flip to your 5-minute or your 10-minute chart and see when it comes back down through the T-line on the 10-minute chart. That would also tell you that they've taken it up, hit a resistance level, and started pulling it back. This becomes more evident when your stochastics have now gotten up here in the overbought condition. A resistance level could be a trend channel. If there's an obvious trend channel forming and you see that they've taken it right up to that level, go to your 5-minute chart and see if they're failing. If they're starting to pull back, that's an obvious place to start taking profits well ahead of everybody else. In this example, the price got up to the 200-day moving average, did a doji, pulled back a little bit, did a doji, came back up, did a shooting star. The next day it opened lower. By that time, stochastics are starting to roll over. It pretty much tells you the story. They cannot get it through the 50-day moving average. It's time to take profits. The aggressive trader might go short. Where's the next target? Taking it back down to the 50-day moving average. Using candlestick signals allows you to observe the obvious. What is the message in this chart? After they started rolling it over, they tried to take it up, but by the end of the day, they were back down below the T-line. They did a shooting star signal and a close below the T-line. That confirmed that if you were short, you stay short, or if you weren't sure if they were going to support off these moving averages, the fact that they were able to close below the 50 and the T-line allows an investor to start shorting on weakness the next day until you see a candlestick buy signal and a close back up above the T-line. A top, again, is developed by seeing sell signals such as the hanging man, followed by a shooting star doji. Now, is this a doji or a shooting star? It doesn't really matter. It still illustrates the same thing. They have taken it up and came back and traded indecisively. Over the next few days, they start taking this back down below the T-line. One of the simple rules about the T-line is the further you move away from the T-line, the higher the probability you're going to come back and test it. So if you start moving away from the T-line, and that's essentially what the part of the trading day does in a shooting star, is up here. It's a good distance away from the T-line. Start watching for a reversal. Again, on your 5-minute or your 10-minute chart, if it starts showing that it's trading back below the T-line, you might take profits up here. If you're thinking of going short and it has created this type of signal, if they open it lower the next day, where's at least your first logical target? The T-line. It's either going to bounce from there and head back up, you get out of the position quickly, or if they can't hold the T-line, that tells you you're still good in a short position until they close it back up above the T-line. Often people ask, is this a shooting star or is this a bearish harami? It doesn't really matter. In this case, it is a shooting star and a bearish harami. The terminology does not make any difference. Once you recognize a signal, in either case, they're both sell signals with bearish confirmation the next few days. It doesn't matter what you call each signal. We just want to be able to take our eyes and visually learn that this is a reversal signal potential, especially if it's confirmed with selling over the next few days. And here's one of our strongest reversal signals, a left-right combination. Notice we have a shooting star, almost a doji shooting star, followed the next day by a bearish engulfing signal. That left-right combination, as we know, is a very strong signal to the downside, which makes this a very easy entry strategy. We see a shooting star moving a little bit away from the T-line. The next day they open up positive and trade positive, but we've already got some weakness. So this would give us more of an alert to put our sell stop one tick below where it closed the night before, with the rationale being that if they took this up and continued it up, it wasn't time to be short. If they took this up and then they brought it back down through that signal or that close of the previous day, that would be creating another signal that would be another bearish signal, and that's where you want to enter this trade. You want to apply all the simple rules that we're aware of with candlestick analysis. One being, if we see a gap up in an overbought condition, start looking for a sell signal. If we've got a nice strong uptrend, where do most people buy? They buy exuberantly at the top. When you see that gap up in an overbought condition, start expecting some sort of sell signal. If this opened, gapped up, and closed up here, you're still in an uptrend. There's no selling. But that gap up followed by a candlestick reversal signal allows you to get out of this position immediately on any weakness the next day. A shooting star signal followed by a close back below the T-line is a good indication you're going to be in a downtrend. And that is very easy to identify, because if you stay below the T-line until the buy signal, you're going to get some good profits. A lot of investors have a hard time trying to stay in a short position or any position, because they think any buying after a certain point tells you it's time to get out. If you stay in it until until you find a signal and a close above the T-line, you will dramatically improve your profitability. A candlestick shooting star signal and a gap down below the T-line is going to be that much more compelling that your downward trajectory is going to be a lot steeper. And trying to put as many elements into alignment as possible, a candlestick shooting star doji hitting a resistance level, then gapping down back below the T-line, with stochastics coming out of the overbought condition starting back down, gives you that much higher probability that you're going to be in a downtrend. This is the whole function of investing, is trying to put your funds in situations where the probabilities are greatly in your favor. Being able to add all the visual elements of a strong sell signal does just that. Let's do a little shooting star review. We'll try to encapsulate all the elements of what makes a strong shooting star sell signal. First of all, we know that if we see a gap up, especially near the overbought condition, and a shooting star, that tells us we want to be out on any selling the next day, because that was probably the last gasp of exuberant buying. Witnessing a shooting star signal in the overbought condition followed by a gap down tells us there's probably going to be a fairly strong price move to the downside. That gap down after a sell signal tells us they want to be out of this position with great enthusiasm. As with all candlestick reversal signals, the further away you move from the T-line and see a sell signal, the higher the probability they're going to come back and test the T-line, which gives you a better probability that if you see a shooting star followed by a lower open the next day, close out the position. You can always see what it does once it gets to the T-line to see if there's any buy signals to buy back. And a shooting star can also be a doji or a bearish harami. It doesn't matter what name you give it, it's still the visual element that tells you that they've tried to take it up and then the bears brought it back down, especially in an overbought condition, telling us it's time to take profits, that uptrend is over. As with all candlestick reversal signals, the bigger the signal, the more compelling the reversal is going to occur. A gap up in an overbought condition, start watching for a sell signal. Shooting star the next day, little hanging man the following day. But this combination has already told us the sellers are starting to take control. When they start trading it lower, you can go short until you see a buy signal, maybe at the T line, or until the downtrend is over. The more elements you can put into your analysis, for example, a big signal, number 1, 2, resisting in the 200 moving average area, 3, they gap it down through the T line, 4, stochastics is heading down, all elements that you should be going short. Or if you can identify multiple signals, a shooting star doji, a spinning top, a shooting star doji, and then selling, and finally the gap down. This all gave a clear indication that the bears were controlling the trend. The bulls could not take the price up any further. Just logic tells us that the bigger this signal is and the bigger the reversal, the higher the probability they're starting to take it in this direction. Doji, indecision. A huge shooting star signal clearly indicates the bulls ran out of steam, the bears are taking control. Then, once it starts trading back below the T line, good time to start going short. There's nothing mysterious about a shooting star. That tail to the upside is a neon sign telling you the bears have run out of, or the bulls have run out of steam. The bears are now taking control. Look for selling the next day. Set your sell stops. If it opens higher and trades higher, you already know there's a sell signal put in. Put a sell stop at a level that would tell us that if it came down through there, the bears were now definitely in control. One of the nice things the Japanese race traders allowed us to take advantage of today is that when you see a signal, we know the simple rules of what should be done after seeing that signal. In this case, there's a shooting star away from the T-line. If you see it trade lower, take profits. Or go short, see what it does at the T-line. Notice all the factors in this chart that would indicate it is time to take profits or to go short. Nice strong uptrend. But as soon as we got up in the overbought area to a resistance level, it gapped up through that resistance level, did a shooting star. This would have been a much different story had it gapped up through the 200 and closed up here. That told us that there was no indecision here at the 200-day moving average. The fact that they did a shooting star allowed us one simple rule, that if it opened lower the next day, we wanted to be taking profits. That would be any trading lower would be bringing us back down through the 200, and it was time to start looking for a downtrend. Gap up, shooting star, bearish confirmation, stochastics rolling over. That's about as simple as you need as far as visually analyzing when it's time to go short. A gap up, shooting star, followed by a gap down. That's essentially like your abandoned baby up here. And notice where it did it. Right here at the same level it reversed before. This is one of the quick visual elements of candlestick analysis that allows us to make decisions very quickly. That if we're seeing a shooting star, abandoned baby, with a reversal the next day, that confirms where it topped out before, that we're probably back in a downtrend. The 50-day moving average provides that same scenario. Come up to the 50-day moving average, stochastics in the overbought area. They get it up through, but come right back down and close below the 50. That tells us that this downtrend is probably still in progress. This is a perfect time to go short because we know that if we're in a downward trend channel, that we would be aiming for the lower end of this trend channel, which would be much lower than this level. A candlestick sell signal followed by bearish confirmation telling us the 50 was acting as resistance and closing below the T line. More compelling reasons to be short this position. And always remember, the further you move away from the T line and see a sell signal, the higher the probability they're going to come back down and test it. Now, that's one possibility. Going short in this area allows us to have an advantage that once it gets to the T line, if it starts showing positive trading, we can always cover it, hopefully with a little bit of a loss. On the other hand, if we see the T lines not acting as support, we know we've got a much bigger downtrend. The charts for candlestick signals allows an investor to visually analyze what is occurring in investor sentiment with a relatively accurate framework. Again, this is not rocket science. This is merely taking advantage of the observations that Japanese rice traders have made over the last 400 years. They were not made wealthy from what they learned from candlestick analysis. They were legendarily wealthy. They were the powerhouse in Japan for centuries. All we're doing is taking the information that they provided for us and trying to learn how to use it correctly. That confirms our training on the Shooting Star. Hopefully you've gained some information from this. As you saw, there was a lot of repetition, but candlestick analysis, because of its visual aspects, needs a lot of repetition for people to learn with their mental eye where and when to start utilizing the signals. Thank you for listening. We'll see you in the chat rooms.